We asked these three questions. When should individual buy insurance? And we talked about frequency and severity, low frequency, high severity, because insurance is essentially a negative net present value transaction. When should corporations buy insurance? The theory, capital asset pricing model, says doesn't make sense. Insurance mainly covers unsystematic risk, but even when it covers systematic risk, your portfolio is paying itself the insurance, so you're just paying employees at that point. But corporations buy insurance because there's other stakeholders besides just the stockholders. So here we're down to when companies can sell insurance. So the first one we said, ability to evaluate the risk, just like Warren Buffett said. Must know when a claim's been filed. You can't have everything going to the court. And then this last group, which is several items, we got to make sure people aren't buying the insurance and then causing a loss, doing something that causes the insurance company to have these large losses because the actuaries didn't price for those events. So moral hazard is the first one did. That's illegal. That's when someone burns their own house down. Moral hazard is legal, but insurance companies essentially charge you more. Once you buy the insurance, you become more risky, so they're going to charge you more for that. That's mainly in auto insurance. The next one, adverse selection, is more on the life insurance and health insurance side. What adverse selection says is people who need insurance are more likely to buy it than people who don't. So unhealthy people are more likely to buy life insurance and health insurance than healthy people. So again, it's a little different in moral hazard. You can kind of get them confused. Moral hazard means that you change behavior. Adverse selection says that something the insurance company might or might not know, and because of that, you're going to try to get a cheaper rate than you should actuarially. So sicker people will want a lot of health insurance, want a lot of life insurance. So how do insurance companies handle that? Well, they price for it by asking a lot of questions, medical tests. They want to figure out what category. We're going to talk a lot about this when we talk about credit scores. The auto insurance side, this is an issue for auto insurance. Bad drivers are going to want to buy insurance more than good drivers. And if you don't control that, good drivers just stop buying because they're being overcharged, which means bad drivers cost even more. Eventually you end up with nothing but just the worst drivers of all. So you have to be able to price these different groups. Otherwise you end up nothing. And that's why I have Market for Lemons. This is a famous article. I don't know if they still cover this article. Did y'all read this article in an eco class? Or I read it in my auditing class. Strangest place, because they want to make argument, why do you need auditors? And so it's kind of, they're using the Market for Lemons to say, if you can't trust used car salesmen and saleswomen, then good used car salespeople are not going to get into the business, which is going to make the people left even worse. So even the marginal ones get out, and so you end up with nothing but a bunch of bad lemons, market lemons. So how do you handle that? You have to find some way to separate the good from the bad so that everything gets priced correctly. And that's what the insurance company says, is we want to charge good drivers less than bad drivers. Otherwise, we'll end up with nothing but bad drivers, but also we want to encourage the bad drivers to become good drivers. We'll get into that a little more. For life insurance, there are certain behaviors that insurance companies just know lead to more claims. So smokers and non-smokers for life insurance, they actually have different tables for smokers and non-smokers. That doesn't mean all smokers are going to die early or have health problems. My aunt was a heavy smoker her whole life. When you saw her at 80, she looked like she's 50 years old. I mean, I don't know, for some reason, cigarettes didn't bother her, but she was, and the exception. Your avocation, what hobbies you have that are dangerous. And then insurance companies have what they call select and ultimate. Select tables are the insurance rates they charge people who've just gone to the doctor. They have fresh information, versus ultimate, someone who hasn't seen a doctor in 5 years, what rate. So life insurance companies handle this pretty well. They do blood tests, they do all kinds of stuff. Annuities, the insurance industry just ignores. Essentially, they assume if you buy an annuity, you must be really healthy or you wouldn't have bought it. So they don't even, I wish they would, Because I know some people who desperately need money that are in bad health. They're like, I may not live more than 2 years, but if I live more than 2 years, I'm going to need the money. I wish insurance companies say, yeah, you're in really bad health, we'll give you a really great annuity, but they don't do that. They just assume everybody that buys an annuity is very healthy. We'll talk on the auto side more and more and more. The biggest issue here is the credit scores, and that's what we're going to talk about. That people with good credit scores drive better than people with bad credit scores. Then you're going to say, well, is that fair? What if we didn't do that? So we'll get into that some. This is what we call underwriting. We might have talked, I don't think we talked about underwriting earlier, did we? I can't remember, but we might have a little bit. But underwriting is a perfectly good career for a finance major to take. It's a perfectly good first career for an actuarial science major to take. If you can't get the exams out of the way, then become an underwriter while you're working on the exams, and then you can definitely get a job, because underwriting is essentially the application of actuary, and they work very closely together. So life insurance, the medical exams, those type of things, and the property and casualty questionnaires, your driving record, they use the government quite a bit. Credit score, we're going to get into those. There's actually, in the state of Texas, there's over 1 million combinations when you do age, gender, credit scores, driving record, geography. When you put them all together, you can almost classify every Texan into a group, because they've got so many different groups. And this is what actuaries and underwriters, so what the actuaries are doing is trying to figure out the groups. So who's riskier, a 22-year-old driver or a 32-year-old driver? Who's riskier, a single 22-year-old driver or a married 32-year-old driver? The actuaries have all that data. They're going to work with the underwriters. Underwriters are to make sure they're classifying the people correctly. So the actuaries say, okay, here's the 10 criteria. This person should get charged $500. Underwriter makes sure they got those categories correct. So the insurance company is actually pretty good at this. They know what they're doing, and they have the data to prove it. So one of the best controls is what they call insurable interest. So this controls morale and moral hazard more than anything else. What insurable interest says is, when people buy insurance, they should still prefer not to have a claim than to have one. Buying the insurance shouldn't push them over the edge so they intentionally have a claim. So insurable interest, for most insurance, life insurance the exception, insurable interest has to be there the entire time you have the policy. So let's say you buy a car, you buy insurance on it, and you sell the car to your 16-year-old neighbor. You can't say, hey, don't worry about insurance, I'm paying for it, I'll just keep buying the insurance. No, the insurance company wants to know who's driving that car. So if your neighbor has a wreck with their car, you say, hey, I'm covered because I bought the insurance company says, no, you were insured, you no longer have insurable interest in that car, you lost your insurance, it's gone. So you have to have ownership of the car, of the house, whatever you're insuring. Life insurance is the one exception. For life insurance, you can lose insurable interest and still keep the insurance. And I've seen this in practice. A husband and wife have insurance on each other, a really awful divorce, they don't want to see each other. They may have even said, I wish you dropped dead, and I have a life insurance on your life. They can keep that policy. When that person dies, they can get the policy, even though they don't have insurable interest. So it's, in life insurance, if they're not sure about insurable interest, they'll just make sure, or whatever life's being insured, that they sign the policy. That's a good way to, if your neighbor comes and say, hey, I want to buy $1 million of life insurance in your life, you might get, if he just moved in last week, you might be like, okay, this is a little unusual. And he'll try to get you to sign the policy, but you might not want to do that. So, all right, so these are all important. Moral and moral hazard are a bigger issue for this class. Adverse selection is a bigger issue for life insurance. Insurance companies obviously spend a lot of time, a lot of money figuring this out. And then the last thing that Warren Buffett did talk about is, while insurance does really good at low frequency, high severity events, they're not good at something that's going to wipe the entire industry out. So just like what Warren Buffett said, the insurance industry is not good at a huge aggregated event. Insurance is really good, like auto insurance. It's unlikely every car in the country has a wreck all at once. Now in Dallas, if they have snow, yeah, you may have a lot of accidents, but even then it's small compared to hurricane or earthquake risk. So there are some risks that insurance industry generally does not cover. Flood insurance is a good example. I saw John Stossel just the other day talking about how insurance industry could cover flood insurance if the government would step back. I'm not sure how much of the math they did on that, but flood can hit an area, a massive area all at once. So it makes it very, very difficult for the insurance industry. Obviously, war risk for life insurance. In fact, war is an exclusion for most policies, just because they can devastate so many areas. You think in Ukraine, they had auto insurance, homeowners insurance. They're probably going through that right now, losing their houses. They may not be insured because their policies may have had war exclusions. That could be an interesting paper for paper 2. War exclusion in Ukraine. I haven't seen any articles about it, but I'm sure that's going. I mean, it was a middle income country with kind of normal kind of products. Terrorism risk might fall in that category. Earthquake, hurricane risks are being debated to be in that category because they can hit massive areas all at one time. So Warren Buffett covered that fairly well as also. All right, we finished paper 1 discussion. So you have those notes. How's your paper 1 going? Anybody finished yet? Still working on it? Here's a good book. I don't know if any of y'all read this, The Signal and the Noise. Anybody recognize that book? So it's statistically, you can see relationships. The question is a relationship there or is it just noise? And the book is about how can you tell the difference. He has an entire chapter on property casualty insurance. This is the book where he says terrorism risk looks a lot like earthquake risk. It has this power log. I think I gave y'all the power log on Blackboard that you can actually see the chart out of this book. So it's a good book. It's interesting. It's a good application of statistics. It's good for finance students because we tend to put a lot of money in the noise. We see a relationship, we get excited because we see a relationship. It's just random noise, and we have to find something. So we try something out. It's also a really, really cheap, inexpensive book. That's pretty good. Y'all probably have heard of Nate Silver, haven't you? He's famous for something. I can't remember what. It was either baseball or voting. I think it's voting, isn't it? Nate Silver. To tell compelling stories about elections, politics, sports. So I'm not sure. He was famous for something here recently, but I don't remember. He may have called an election better than anybody else or something. Anybody know? He's famous for something. So I mean, that's more you can say about me. I'm not famous for anything. So he's famous for something. I just don't know what it is, but you can read his book and find that out. Okay. All right. Questions up to this point? So what I covered so far will really help you in an interview with the insurance industry on the property casualty side, because not many undergraduate students take class this specific. So just having an understanding of this business, it is very different than most other businesses. So let's look at the industry itself. So just understanding, if you interview with an insurance company, you're going into a sector. There's 11 sectors, maybe 12. I can't remember now. They keep breaking them up. But sector would be like utilities, technology, communication services. That's where Facebook and Google and telecom is. Manufacturing, consumer discretionary, consumer staples. So what used to be the biggest sector, but isn't anymore, is financial services. There was a point in time, like in 2007, where financial services was the largest sector. It was like 30% of the stock market. It's shrunk quite a bit from there, but financial services. And then there are sub-industries under financial services. There's more than just this, but typically banks, investment, they moved real estate to its own sector for some reason, and it's the smallest sector. I mean, by far, it's just itty bitty. Real estate is huge, but very little real estate is actually traded as stocks. So most real estate is privately owned. So they move real estate out, but banks, investment, and insurance. So we're in the insurance world. So the insurance world is usually broken up between life and property and casualty. Not only is it broken up like that from understanding the industry, it's also broken up like that regulatorily. If you're a life insurance company, you sell life. If you're property and casualty, property and casualty companies don't sell life insurance stuff. They always regulatorily break them up. On the life side, they sell individual products and group products. Most do both, but they usually, the individual products would be like you go buy life insurance from them, you buy an annuity from them. The group is they'll sell group life to an employer so that they cover all of their employees. It'd be a group product. So they're selling one product to an employer that has thousands of employees. Property and casualty is very, very different. On the life and health side, the customers are individuals and employers usually. On the property casualty side, it's individuals and corporations, not necessarily employers, but corporations. So you have the personal lines and the commercial lines. Generally, most companies are one or the others. So when you think of USAA, which side are they on? Do they sell the individuals or corporations? Individuals. State Farm, personal lines, Hartford, both. They're kind of in both of them. Chubb, mainly commercial. AIG, mainly commercial. They probably do some personal lines. So most companies tend to skew one versus the other. So Allstate is almost all personal lines. The big auto writers tend to be predominantly, but Hartford is in both. And then within that, they break out the property and the liability, but it gets a little confusing because I'll show you late in the class, we're going to look at the details of how they break up their products. But they definitely own auto. When you look at the financials of an insurance company, they have auto physical, auto liability. They treat it almost as two products. But you don't notice that, do you? You feel like you're buying one product. But from the insurance company, from an actuarial standpoint, they have the physical side and liability side, and those are two different things to them because the math is so different on those. Same thing on homeowners. You have the homeowners, and then you have the liability side. And then we have some special cases we're going to talk about. Medical malpractice, product liability. We talked about directors and officers. All those special cases that only apply to the commercial side. They also break out workers' compensation as a completely separate product. So most firms, if they do workers' comp, that's probably about all they do, unless they're a major reinsurers. So there's a lot of companies that do nothing but workers' comp. And in fact, there are some that are almost state-run pools, almost state organizations. So workers' comp. And then there's others, and there's strange in here. The one I think is the strangest, we may talk about this later. I hope someone does this in their paper too. I hate title insurance. I wish we would get rid of it. Some of your parents may work in title insurance. If they want to debate me in public, come do it. I just think it's a grossly mispriced insurance. And there have been some states that have found a way to get around it. It's somewhat a monopoly. It's got a lot of political power, and those monopolies dominate. There's just a few players who dominate this market. My question is, why can't USAA and State Farm sell title insurance? I think they would, if they sold it, they would sell it 80% cheaper than what it currently is. I was shocked when I had to buy title insurance. This is crazy. There's no reason I should spend that much for this product. Now, they argue they add value, so we may talk about it later, that they're doing more than just the insurance piece, but there's been some debate. Here's one area where, I forget what it's called. The Bitcoin, what's that chain called? The, I can't remember. But this is one area where Bitcoin and all of that, that protection, the real key with title insurance is there's some way we can prove who has title. We don't need this insurance. And there's people are thinking, in fact, it's been experimented in some places. There's some places in the world that don't have title insurance at all because their laws just completely negate the need for it. So anyway, we'll get into that. It's a really, you'll see why I think it's so mispriced when we look at loss ratios. Because you'll see with auto insurance, the loss ratios are like 70-75%. Homeowners, it's 60 to 90%. Title insurance, it's like 5%. If they get $100 in premiums on average, they pay out $5 in claims. That sounds like a really good insurance, doesn't it? You know, I told you insurance is a losing proposition because you pay 100 and you only get 70 back, but here you pay 100, you only get 5 back. It's a really extremely expensive insurance. But title insurance tends to only do title. That's all they do. And you've probably seen some of them, American Title and those type of companies out there. Jobs and insurance. Well, here's the underwriting piece. So obviously there's actuary. We have a few actuary majors in here. They're going to have to decide the life actuary versus property and casualty actuary. There's a lot more P&C actuaries than life actuaries. I think the life actuaries to me is more interesting because you get the investment side, where on the P&C side, you don't get the investment side, but it kind of depends. On the P&C side, the actuaries are broken into very distinct groups. You've got the pricing actuaries. They're the ones out there looking at the statistics to try to figure out how do you price a 22-year-old versus a 26-year-old, male versus female, where they live. You know, it can be immaterial. You move 5 inches outside of Bexar County and your rates can drop dramatically. Why do they think 5 inches outside of Bexar County is less risky than 5 inches inside of Bexar County? You know, those are the kind of things, the data that they're looking at very closely. The reserving actuaries are the ones at the end of the year have to set up the liabilities for how much you're going to owe in the future. Very different group of people. And then the reinsurance catastrophe actuary, that's what Warren Buffett was talking about, because that's what he does. USAA had reinsurance and CAT actuaries that looked at insuring those massive risks, those ones that are the multi-billion-dollar risk. And then you have a product development type of actuary. So actuaries move in all these areas. One thing I should have mentioned that's not in here is decision science. I'm seeing more and more actuaries going into decision science areas. So a former student from this class, she has spoken to this class a few times, but she changed careers. So maybe I'll ask her again this year, but I think she's been too far away from this. But at her end of her career at USAA, she was in a decision science department, but a bunch of people in that department were actuaries that moved from actuary into that area. So she had some PhDs in math, she has an economist, some actuaries, and then she was in there as well. And it's just because an actuary can do math, can move between these jobs pretty easily. Obviously, you can be a P&C actuary and then move into decision science and property and casualty. So we'll talk a little later when we talk about telematics, but that was her job, to figure out telematics. If we put this stuff on a car and it monitors your driving, what does that mean for our statistics? So a lot of jobs in actuary, very high paying jobs, not particularly stressful jobs. Always loved working with the actuaries at USAA. Then the investment side, which is where I worked, on the life insurance side, the investment side works very closely with the actuaries. It's hand in glove because it's a spread business. The actuaries say, hey, with this product that's going to pay 3%, we need you to buy a corporate bond that pays 5% so we can make our profit. Not so much on the property casualty side. They don't always talk to each other hardly at all. USA was a little unique that I interact with the actuaries, but that's because I wanted to. So I actually made a point to go talk to those guys all the time. But there's some firms, the actuaries never talk to the investment side. Underwriting, very important department, huge department, doesn't pay as well as actuaries, but it still pays very well. Hardly pays about as well as an accounting job would pay. So it's a good paying profession. It's very specific to an industry. So that's the downside of being underwriting. Underwriters can work for property and casualty companies, whereas actuaries can go anywhere because it's more general math, heavy statistics. So if you stay in underwriting too long, you're kind of going to be stuck in that industry for the rest of your life. But it's a perfectly good career. Policy service, those are the on the phone jobs. You're changing addresses, changing coverage. A good friend of mine, she was the person I went to at USAA. She was a cousin of a really close friend of mine. So I did all her 401k investing, and she did all my all my property and casualty. So we kind of shared the burden there. And the reason I like calling her is just her knowledge. It's amazing. You know, every state is different, and there's these little nuances. And she knew it. She'd been in that job for 30 years, 40 years. She knew exactly every question I could ask her. She knew the answer to. That's why I think it's, if you're going to travel to Mexico or to Costa Rica or overseas, and you're going to rent a car, that's when you call these policy service people. They'll know off the top of their head. Oh, if you're going to Mexico, make sure you do this. Like Costa Rica, I rent a car in Costa Rica. The insurance is ridiculously expensive. It's more expensive than the car. Why is that? Can I not get it? What happens if I don't get it? Is it illegal not to have it? You know, those kind of questions. These are the people that can really help you with that. So it might sound like, you know, they're just doing kind of manual labor, just changing things on the computer, but they have a deep knowledge of each state's requirements for each product. Sales, that's a bigger issue on the life insurance side. I know there's a life insurance company that is heavily recruiting here on campus. How do you know when you see a life insurance sales job? They ask you to list all your friends and family members. Why do they do that? You're listing all the people that will be avoiding you the next 6 months, right? Because you're going to be selling life insurance. That's what sells. Some people are great at that. They love selling. I would talk people out of every product I would sell. So claims is a tough job. When you work in claims, you're picking up the phone and the person on the other line is really mad because one of your customers just wrecked their car. They assume you're going to rip them off. So they're not in a good mood at all. It's that kind of constant, just people are screaming at you before they even know anything about you. It's a tough job. I only know one person in that job that loved it. And I remember talking to him and we were like, you're really strange because that's a really tense job. That was one area I know USAA used to have sick leave. And these jobs, they took their sick leave 100% of it every year. And I was like, yeah, I can see it. And they should get it. They should be able to do that because it's a tough job. But if I were an actuary, that would be a great place to work because you're going to learn the product so well there. So that lady I was just mentioning, that's where she started. And she said it was a tough job. It is a very stressful job. But she said she learned stuff there she could not have learned anywhere else. So if you're an actuary major, spending a year or two in claims would be really quite valuable to you because you just can't learn that stuff anywhere else. So
does that department have like the high turnover rate?
Yeah, they do. I'm sure there's people that have had their whole career there and you move up in management, those kind of things.
Probably easier to get in that department then.
Huh?
Probably easier to get in there.
Oh yeah, there's a lot of it's a very high level of employee. I mean, you need a lot of people.
Right.
And so yeah, it's just constant work. It goes up obviously when the weather gets bad and those kind of things. You get a lot more calls or you get hail damage. But yeah, they're pretty intense phone calls. Mm-hmm. I sat next to a claims department, not for property and casualty, it was for disability. And I remember just thinking I would never work in that job. That lady, oh my word, she was so sweet on the phone, and she hung up and she just started screaming. She was so frustrated, and she was right across from me. It's like very distracting for me, and I felt so sorry for her because she was just talking to people that just weren't listening to her, and they were mad and all this kind of stuff. She was so sweet and friendly on the phone, though. Then you have just your normal staff functions, accounting, those type of things. Insurance companies do have an entire department just for the government called regulatory affairs. At USAA on the life side, it was maybe 20 people. On the property and casualty side, it was hundreds of people. It's just massive. You guys have to deal with all these states. There's a very regulated industry. And so you just have to do that. Banks don't have that as much, although with the Dodd-Frank bill, banks are adding more regulatory departments and they're building those up because these laws are getting quite complicated. I wouldn't recommend you work in a regulatory affairs department, but they do have those. I'm going to try to get a insurance day here at UTSA this semester. Invite USA. I've got them that they'll come. What I want them to do is do one for the accountants, do one for finance, do one for actuary, one for cybersecurity, and then maybe all these others, underwriting, claims, just and separate it out. And then I need to invite Allstate, State Farm, Farmers, some of the other big players that don't recruit here. USA recruits here. USA loves UTSA students, hires a lot of them. But State Farm, Allstate, they don't even know we exist. So I'm going to try to get that maybe late March, early April. We'll see. We've got some money to fund it, so I'm going to try to get that done. All right, so it's a perfectly good industry. So the difference you have versus when I graduated, it was just get a job. Just let your industry pick you. I don't know if you can do that anymore because there's industries that are disappearing. So you have to be somewhat leery. I don't know if Valero will exist in 20 years, probably, but it's going to be a very different company if electronic vehicles take over the world. If autonomous vehicles take over, then USA would have to shrink pretty dramatically. So you have to think about that, but a good chance this industry still be around 40, 50 years from now. Enrique, do you have a?
Oh, I was just gonna say, since you were talking about getting like set up for there's a career text from even HEB on February 8th through the 6th.
Yeah, I know this early in the semester. I want to do one focused on insurance because that's where I have the money. I have money that can only fund insurance related topics. And I want to bring in I'll work with that group and with Julio's group as well to make sure I contact. We were going to do one in March of 2020. You can kind of guess what happened to that one. So I want to try to get that reworked again. It's an industry that has a lot of jobs. It's a huge industry. And it's not recruiting at UTSA other than USAA. All right, one last thing with insurance that's really bizarre is the legal structure. Insurance companies can be regular stock companies. Allstate, Hartford, Chubb, these are regular companies that trade on the stock market. Nothing unusual about that, AIG. But there's also mutual insurance companies. They're kind of like credit unions. They're owned by their customers. So they're non-public, owned by their policyholders. They may own insurance companies that are stock companies, but they're not publicly traded. So State Farm has a life insurance subsidiary. It's a stock company, but it's 100% owned by State Farm. So you won't notice that. So State Farm, Northwestern Mutual. There's some other big ones, but a lot of them have gone away from that. Then you have reciprocals. Reciprocals is very similar to mutual funds. They're owned by their policyholders, but they have a special tax treatment. The CEO has a special role that I don't completely understand. The only reciprocals I know are Farmers and USAA, and USAA is kind of the most prominent one. It's a fairly unique structure, very unique tax treatment. I was somewhat shocked when I learned the tax treatment because I was responsible for coming up with assumptions for investments, and USAA was the only entity I know that their after return on stocks was higher than the before tax. So after tax return on stocks was higher than the before returns. They actually made more after tax than before tax. That's pretty cool. You can get away with that. But it's just the way reciprocals work and the way they can allocate their gains. Pretty unique. Now, Farmers is supposedly a reciprocal, but Farmers is also owned by another company. I don't understand that. I need to research that more, but Farmers has traditionally been one of the reciprocals. You do have a tough time telling difference between a mutual and a reciprocal. They seem quite similar because of their owned by policyholders. I think the big difference is mutuals can demutualize. Mutuals can become stock companies. I don't know how USA would do it. I guess it's possible if USA wanted to go public, become a stock company. I don't know what you would call it, but it would be a very unusual transaction. But mutual insurance companies do demutualize. What that means is they were mutual, but now they want to trade on the stock market. So what they do is they go to the regulators. So Prudential is a good example. Prudential used to be a mutual. I'm talking about Prudential United States, not in the UK. Prudential used to be a mutual insurance company. They went to the regulators and said, we want to be a stock company and trade on the stock market. Prudential had to come up with some formula in order to convert all those policyholders into stockholders. And that's where you have to get the regulators to approve. Mutual of New York, have y'all heard of them? You probably know them on a different name. Money. So they're now called MONY, Money. Have y'all heard of them? So they demutualize. My dad actually had life insurance policies from them. And when they demutualize, they had to change their name. You can't demutualize if you have the word mutual in your name. So now they just go by Money. But what happened is my dad was mailed shares of stock, and these actual paper shares of stock. He thought his life insurance was canceled, but it wasn't. He still was a policyholder. He was also a stockholder. So he was mailed those shares. And so we became shareholders in an insurance company. And then my brothers are all debating, well, do we keep it? They want to do all this analysis. This is a good company. And my basic question is always the same. Were you going to buy shares in this company before they sent you the shares? No. Well, then why would you hold on to them? You know, you had no interest in it before, so just sell them and get out of it, because why waste your time analyzing the company that has no track record? So just sell and get out of it. It wasn't all that much, but that's what happened. They just sent. Now, how did it decide that my dad got 15 shares or whatever? That's the formula you had to come up with and approve with the state. And then once you do that, all their customers have shares, and then they sell their shares, and then eventually the stock market has just become a normal company. Why did they go public? It's easier to raise money that way because they can issue shares of stock. And some people think CEOs like having stock options. They can make more money that way. And you can't do stock options if you don't have shares. So that may be the reason. But there's been more demutualizing. New York Mutual, I don't think, they're kind of committed to always being a mutual insurance company. State Farm, I think, is somewhat committed to always being a mutual. Enrique?
So how you were just saying USAA was to neutralize and just make go public. Would they be able to take like any kind of like average Joe off the street that wants to take with them or get insurance for them, or would they still?
Well, they can kind of do that. They can kind of do that now. So, and I haven't worked there for 12 years, 13, 14 years. But when I was there, the auto and home was only for the members. The bank was open to anybody. The life was open to anybody, but they didn't market to anybody. The investments by law was open to anybody. So they had products they had to sell when people showed up. But the property and casualty, the auto and home, that you had to be a member to get the product there. But they've opened up so much the enlisted market, so it's kind of they're advertising so much more now than they did before.
Mom talks about them being like they were exclusive for so long, but now like
when I started there, they were much more exclusive. When Bob Davis came in, he started opening them up pretty radically. But yeah, if they did become a stock company, it would probably affect the auto and homeowner somewhat. Now, the strange thing with them is there is a difference in risk between military people and non-military. Military officers do drive better and they do die slower. So life insurance is really good, really cheap. Auto insurance is really good. They didn't discover that on the enlisted side. Enlisted military don't drive as well as the general public. But they do have better life insurance. So it's a unique group of people. And part of what USA's argument was is if you're in the military and you have a DWI, you're out of the military. So they kind of saw the military as doing the underwriting for them. that didn't quite work with the enlisted the way it did with the officer corps. So, so I think they've broadened themselves out so much now that I don't think they're all that distinguishable from the general public, but it is a unique company, no question. All right, any questions on this industries? So, definitely interview with them. If any of y'all get on with State Farm or Allstate, let me know. We had one student in this class who works for a local State Farm office, but I haven't heard from him since he graduated. I need to probably contact him again. You've seen the little State Farm boxes all over the place. So you can, it's somewhat of autonomous. If you want to be on the sales side, it's somewhat of an autonomous business. My last experience with them was on a claim that I knew they weren't going to pay. And I called them 3 times, and all 3 times they said, we'll get back to you. And they never called me back because I knew they weren't, because it was a ridiculous claim. But I was calling them on behalf of somebody else. And I said, yeah, I'll do that for you. So, but they're there, they have their customer base, and it's a unique kind of business, kind of a little autonomous, I think. All right. So let's get into our first product, homeowners insurance. So how many of y'all know if you have homeowners insurance? Either know you have it or know you don't have it. Just one? You know for sure whether you have it or not?
I do,
Or
sir.
you're like, well, maybe my parents. So if you don't own a house, can you still have homeowners insurance?
No.
I'm in a condo, so I have homeowners insurance. What if you're renting an apartment? Can you have homeowners insurance? Yeah, renters insurance. So if you are renters, should you have renters insurance? So that's part of what we're going to talk about, is what should you have? Homeowners is what we call a packaged policy. That's probably ED on the end. I probably left that out. But it's a package policy. What that means is it includes both property and accident all in one product. You don't really notice the distinction, but the insurance industry certainly sees it as 2 different products. So it covers both property and liability. I'm going to use the ISO because we're not going to go in detail on these policies. The typical class like this, we just spend weeks and weeks and weeks on policy details. If you're going to be on the sales side or the policy service, that's where you have to learn that. But there's no reason to do that because every state's different. So we'd be somewhat overkill. So we're going to keep it pretty high level, so we don't need quite the detail there. Who can buy homeowners? So if you own something that's primarily for residential purposes, you can have that. If you're renting a dwelling primarily for residential purposes, you're eligible. If you own something that you only occupy some of the time, it still has to be principally a residence. So this is where the Airbnb people probably have to have some concerns. I don't know what the Airbnb issue is. It's interesting. There's an entire company called Buckle Insurance. I don't know if y'all have heard of them, but it really doesn't matter if you've heard of them because they just went out of business. So it didn't work, but they were going to sell insurance to the gig economy. Airbnb, the Uber. So I thought it was I actually spoke to them several weeks ago because they hired 2 of our students, unfortunately for them. And I said, yeah, I mean, this is a much needed business, and our webpage is still there. They say they're better. Maybe they sold off their business to somebody. You can see the kind of things, DoorDash, these kind of, it seems like something we really need, doesn't it? Seems like a perfect business to kind of handle those kind of things. Call up Uber, call up Lyft and say, hey, we got a product to help your employees. Can we do business with you? That seems like a perfectly reasonable business. So if you're doing Airbnb, there's going to be some rules on how often you're there versus somebody else. You're renting out. I know people who buy places just for Airbnb. They're not intending to live there at all. That's not going to be a homeowner's policy. So business has to be incidental. So if you're a painter, you're doing sculptures or whatever, and you use part of your house for that, that's probably okay if it's secondary to the house. Multifamily can work, but there's some limits on that. There are size limits. I know these super small houses have been really popular. I don't know how small a house gets that it's not going to fall under homeowners insurance. I've seen some pretty big houses. I don't know who's insuring them. We had dinner when I was in a Longhorn band, 400 people. We had dinner at a guy's house. That's a pretty big house. And they had a house for the butler and the maids in the back that was like 10 times bigger than my house. So that was a massive house. So he may have had to buy a special type of insurance. So there are some people that can need homeowners insurance where they don't own or not a renter. So a life tenant is a good example. I saw a life tenant next to where close to where I live. It's a lady who sold her house. The people who bought it, their agreement was, we own your house, but you can live here until you die and then we'll take it. USAA somewhat had that. So the lady, I don't know if you all know the history of USAA, but the lady who lived on that land, she had her house there. She sold all her land to USAA. The agreement was she could live out the rest of her life in that house and USAA would just build around her. And then when she passed away, they said, well, that's fine. We'll make that the CEO's house. And no CEO wanted to live there because who wants to live on the campus where you work? So they converted it into a really, really nice conference area. I don't know how long she lived there. I should look that up, but I think it was quite a while. She was there for quite a while living on the land. So she would have a reason to have homeowners insurance, even though she didn't own the land. She wasn't renting. She's living there for free, but she could still buy some insurance. Although what could happen to that house? She's right next to an insurance company. All right. So what kind of policy form would you have? So the policy form really focuses on the property, what property is covered. So the liability side tends to be the same for everybody. And we'll look at the liability side. So when we're looking at these policies at high level, there's going to be a section for property and there's going to be a section for liability. For auto insurance, for homeowners insurance, it starts with the property and ends with the liability. For auto insurance, it starts with the liability, ends with the property. So why? Because the liability is the bigger part of the auto, property is the bigger part of the homeowners. But there's a property piece and a liability piece, and then there's others. The policies can be all risk, or they can be named risk. All risk sounds really good, but it's all risk unless excluded. So if you have all risk, then you want to read in detail what's excluded, like war. War is not covered. Nuclear events are not covered. So you want to know what's not covered. And if it's a named peril, then you want to see what is covered and start thinking about what are you worried about that's not in that list. If it is covered, if it's a named policy, it can be basic or broad. And this basic versus broad is going to come up when we talk about mold risk in Texas and what insurance companies did going back to the very, very basic coverage because they were losing so much money in Texas. You don't need to know these forms, but just basically, there's the HO2 and HO3. It's just how much is covered. So HO2 specifically named perils versus just all risk. Most of you are probably all risk, so it's everything's covered unless excluded. Then you have those that are specifically for people that are renters. I call it renters insurance, but it's the HO4. And then condos. This is where I am. Condo. Now I own my condo, but I share a roof and walls with neighbors. So who owns those? Well, we don't insure that. The condo association handles those. So if our roof gets destroyed by a bunch of some storm or whatever, the condo insurance is going to cover that. So I get a policy for the condo, then I see what's covered there, and then I'm on personal coverage. So if you're a renter, you would get HO4. If you have a condo, you do HO6. Unless you're renting a condo, then you have HO4. If you own a house, then you do either 1 or 2 or 3. All right, so what's in these? The preliminary section is essentially the same between auto and homeowners insurance. The preliminary section is just telling you what's insured, who's named, what property's covered. So who is the insured, what property is insured, what are the limits, what are the deductibles, what are the premiums. We'll talk a little bit about deductibles, but we'll get into too much detail on that. And then there's some general things that you're agreeing to do and the insurance company's agreeing to do. So there's things that the insurer is obligated to do as long as you pay your premium kind of stuff. You may have some requirement to protect the property if something happens. You know, if a hurricane comes through, that you don't leave all your doors and windows open and go on vacation, you know, those kind of things. There's certain things you need to do. Call police if something gets robbed. And then there's a whole list of definitions. My guess, if you have a policy, none of y'all have read any of this, you might want to at least glance through it just to see what's in there. I mean, if you have this policy and you don't know, you know, what kind of perils you have covered, you might want to read them to see. And then we get into property coverage. So property coverage is essentially 4 things here. So first is the main dwelling. Secondly is secondary dwellings. Third is your property inside the dwelling, your couches and refrigerators and those kind of things. And the last thing is, what if you can't get to your property and you need to rent out a hotel for a few days? Okay, so those are the sections. So coverage A is the dwelling, coverage B is other structures, C is your personal property, and D is loss of use. Okay, so those are the 4 sections you have. You don't really care about B if all you have is a house and nothing else. But if you have a big shack in the back, you know, like an extra room in the back, you have a separate garage. I know I visited some friends in Corpus Christi, and they had a dock. They're right on the river. Is that part of the house or is that other structure? That's something they would want to know. Why do you care? Well, because the limits. Coverage B is limited as a percentage of coverage A. So you better make sure that if coverage B is limited to, you know, the standard is 10%, then you better make sure those other structures aren't worth more than 10% of the main property. If it is, you need to go get additional coverage. Now, I know a lot of people that they're scared to ask the insurance company that question because they're going to have to pay more premium. But you're buying insurance to cover you. If you don't have enough insurance, you're going to find it out when you have a claim, and then you're not going to be too happy about it. You're better off saying, hey, I have a dock connected to my house. Is that other structures? And is 10% going to be enough? That lady I went to, she knows all of that off the top of her head, or she knows formulas she can do. You want to ask those questions. If you ask the question and your premium goes up 40%, you don't have to buy the extra coverage. You just know that you're not covered now if anything happens. Buying insufficient coverage and just hoping for the best is not going to serve you well in the long run.
Yeah, that is, what was it, principal investments or real estate finance, where everybody always wants cheap. But
Yeah.
then when the time comes, when we need coverage, oh, well, it doesn't cover it. Well, you got cheap insurance, that's what you get. You kind of have no choice. You kind of have to spend money on insurance.
Right. Yeah, because if it's more expensive, they're telling you
Right.
you've got a risk. You should be worried about this. That's why it's more expensive, because we know there's a good chance it's going to happen. So you should think about it that way.
Everybody always wants cheap, but then.
Yeah. And yeah, cheap just means when the claim happens, you're not going to get fully covered. So you're going to be paying more out of your pocket.
When would you say too much insurance?
Well, that's why I talk about rate online. So get that deductible. So compare what happens to your premium as you move that deductible. You remember we talked about that 2 classes ago. Try to find that sweet spot. So you're getting good coverage, but you're not paying, you know, don't expose yourself to $100,000 in risk to save $2 in premium. You know, but don't spend $400 to get an extra $1,000 in cover, you know, that's kind of thing. So, yeah. All right. So on the property side, fixtures, those kind of things are generally covered as part of the dwelling. That can be tricky. So, you know, you can ask that policy service rep. So is it part of A or is it part of C? I've got a couch. Okay, that sounds like personal property. It's not part of the dwelling. Okay, that's fine. Well, I got this built-in appliance. The way I think about it, this may not be perfect, but if you were to move that appliance, it would cause damage to the, I mean, the house wouldn't be as valuable. So that's kind of way of thinking about it. It doesn't work with everything. If there's construction going on, those kind of things, you know, those kind of materials can be covered. Theft is very high in construction areas. I had this guy stop. I think he was accusing me of theft, but I ride my bike in this neighborhood in Lotus. And he says, "Do you see anything? Someone stole a lot of stuff from my house." And I go, "Well, is there any construction going on in your neighborhood?" "Yeah, right across the street." I said, "Yeah, you got perfectly ethical people, but they're in somebody else's neighborhood and they're sitting there watching your house all day long. One out of those 10 workers, if they're not a good person, this is like the perfect crime." Construction areas, I mean, you don't rob your own neighborhood if you work in another. So, you know, that's just the nature of it. If someone's building near your house, you've got a lot of strangers coming into your neighborhood and they're going to be sitting there watching you. One of those 40 workers may not be a good person. So yeah, the frequency goes up. But I think he was thinking I stole it. I'm like, yeah, I've got it in my backpack on my bike. Yeah, I go around and still 50 pound. Huh?
Did you have a backpack?
Yeah, I always have a backpack, but it wouldn't steal what he said was stolen. Other structures, all kinds of stuff, but there can be questions, but that's why you call the company and ask, is this garage part of the dwelling or is it other structures? Those kind of things. Garages, sheds, fences, driveways, sidewalks, patios, those kind of things. Piers. Now, if you have an additional structure, but all you do is business back there, that can change the nature of it as well. You may have to have a separate policy that's a business policy. You're limited 10%, but you can get more than 10% with endorsements. So endorsements are always possible. So, you know, that's what you do. Personal property contents. Who was I talking? Was that you were talking about? Personal, someone was talking about it. So the wonderful thing about Part C is it covers you everywhere in the world. Doesn't matter where you are, it's covered. So it doesn't just cover stuff in your house. So if you have really expensive golf clubs and they're in your car and they get stolen from your car, your homeowner's policy will cover that. Okay, anywhere in the world covers you, with a couple exceptions, including, this you got to be real careful. If you own another house and you keep your stuff there, but you don't have that house insured, you're a little bit at risk there. Because with the insurance companies thinking you should have insured that house. So you gotta be a little careful there. And there's a limit, but you can get additional coverages here. Here's where I sat down with this lady, and I just, you know, I'm a cheapskate. So I was like, what do you have that would be unusual? Nothing except for clothes. I have a lot of clothes because I got real busy one time, and instead of doing laundry, I just went and bought new clothes because I was just so busy. So I told her, yeah, I got a lot of clothes, but it's, you know, it's clothes from the 90s. No one wears them anymore. So, but yeah, I just went through everything I had. I don't have anything really that unusual. So there wasn't anything to add, but you can add, you know, if you have some really expensive artwork and those kind of things, you just go through it. And one thing you really want to do is walk around your place with a camcorder and get a picture of everything you own and keep receipts, and then take pictures of receipts, and then don't store that on your computer at home. Put it on some offline thing so you have access to it. That helps a lot to have that kind of documentation. So the limits are lower if you own a property that you don't have insured. You're going to have some limits there. You got to be careful there. So endorsement just means you buy additional product. There are some limits. One of them is related to that moral hazard. The insurance company doesn't want you to store $50,000 in cash on your mattress. They want you to take it to the bank. So say, okay, cash is covered, but there's a limit. Securities, important legal documents, go put it into a safe. You know, make sure all that's covered. Watercraft, trailers, those kind of things. You got to, you know, expensive firearms, furs, those kind of things. Those you're going to have to insure specifically. Y'all have seen Antique Roadshow. They say the insured value would be, they're saying you have to buy a separate policy just for this thing. So they're essentially saying, hey, you got this painting, no one knew existed, it's worth $5,000. You can't just leave that in your house and hope your homeowners covers that. You need to specifically identify that and have it insured. So there are limits to values. So high value items are not insured under the homeowner's policy. They're insured by those separate policies. Animals, birds, and fish are not covered. Motorized land vehicles with some exceptions, but obviously auto insurance covers those. But a wheelchair, some like golf carts used around the premises can be covered, but they don't want to insure under homeowners something you would drive in regular streets and roads. It doesn't make sense. Stuff that's in your car is covered by auto insurance. If you own a plane, that's not going to be covered by your homeowners. Now, if you have tenants that have their own property, they need to buy their renter's insurance. So they need to buy their own insurance, and some others. So if you're doing something unusual, ask about it. If you do have a business, I remember a lady, she was doing a floral business. If you have special equipment just for that business, you better talk to your insurance company about that. If you're just assuming, never just assume the homeowners covers it. If you're doing something unusual, tell them and they'll let you know. And if you're doing Airbnb, I would absolutely be talking to, even if you only rent it out, 1 month out of the year or whatever. All right. So have a good conversation with your policy rep. Coverage D is loss of use. ALE is what it's called, additional living expenses. This is getting you an apartment, whether repairing your house, those type of things. Your property doesn't have to be damaged for this to be covered. So if you live in a place where a covered event destroyed all access to your home and your home's perfectly fine, it will still cover you because you can't go to where you're going. As long as it's a covered event. If it wasn't a covered event, then you're not covered. So you have to watch that. And again, it's set as a limit. Once you hit your limit, you're done. You don't get any more coverage. So make sure you have adequate coverage. You should be asking those questions like, is 20,000 really enough? What if I do this or whatever? Be careful on those. All right. Obviously, your renter's policy is really only personal property. That's all it's covering. So who I was talking to, was it you? Yeah. So, think about it. If you think renters, all you do is think about your apartment, what's in your apartment. Don't do that. Go broader. What do you own anywhere in the world that you want to make sure if it got stolen or got destroyed, you had coverage, and this would cover it. Don't say I don't have to worry about it because I keep it in the car. Well, your auto insurance doesn't cover that. Okay, it's the fact that you store it in your car. Like my bike that got stolen, it got stolen out of my car. My homeowners covered that, not my auto insurance. Other coverages you get, debris removal, reasonable repairs. There are certain things on your land that can be covered. The land itself is not covered, so that's a problem if you have some mudslide or something. The fire department has to come, that can be covered. Property removal. So if a hurricane's coming and you get a U-Haul to take stuff off, that can be covered. I remember when the Medina, I don't know if y'all, well, I always say remember, and then I think that was like 20 years ago when y'all were like in preschool. But Medina Dam, they're worried it was going to actually collapse. We have major flood. I had a friend that lived out there in Castroville, so I came out to help him move. And it's pretty cool because the news media showed up. We'd already put everything in a U-Haul, and the news guys showed up, so we took stuff out and reloaded it. So we got on the news that night. It was pretty cool. But unfortunately, it was flood. He had homeowners insurance, but he didn't have flood insurance. So he had no coverage because I remember his conversation with USAA. I heard him say, "What about 30 minutes?" And I knew exactly what the sales rep just told him. Anybody know what she just told him? Yeah, she told him there's a lockout of 30 days. So you can get flood insurance, but you don't get it for the next 30 days. That's when he said, "Well, what about 30 minutes?" And he was a pretty funny guy because his house was about to have 3 inches of water in it. And I kept running into him because he kept wiping his feet every time he walked inside. And I was like, "Why are you wiping your feet?" But anyway, it was pretty interesting, but he didn't have any coverage. But if he had coverage, that U-Haul would have been covered. He just drove it and parked it up on the top of a hill. The insurance company wants you to do that. They're willing to pay for that kind of thing. Forgery and those kind of things are covered. I've never filed a claim like that. I've had a lot of credit card fraud. My bank has essentially eaten all of that. So I don't know if any of y'all had a credit card loss where you had to pay for it. To me, the credit card companies always they cancel the card, but they just cancel it. I tell them it's fraud and they cancel it. I've never had a forged check. Anybody have a forged check? That could be covered. Usually the bank covers that too, right? Because they should know your signature and if someone forged your check. So a lot of this is going to be covered. Counterfeit money can be covered. I've never, as far as I know, had that. The limits can be kind of low. You do have some requirements. So if your credit card's been hijacked or a check's been forged, you can't say, oh, I got insurance coverage, so I don't care. No, you need to shut the account down. You need to act so that no more losses happen. Now, what about identity theft? I was talking to an actuary at UTSA about that, and he said, I think we should provide identity theft insurance for free. And his argument was the losses are so minuscule. Most of the losses are just frustration and hassle. People don't usually lose a lot of money with identity theft. They just lose a lot of time and hours. And he thought, it sounds good, just give it for free, make it part of homeowners. Our policyholders feel good and the loss, but that was his argument. I don't know what kind of data he was looking at. Loss assessment can be very, very important here. Now, this is for property. It might be more important for liability, but loss assessment is you live in a homeowners association and they have some losses. And so they assess everybody in the neighborhood. Your insurance can cover that. And then there's some special things related to glass. You got to be real careful. If you're going to leave your place vacant, I would talk to your insurance company. For some reason, people like throwing rocks through vacant houses, windows, and causing damage and those kind of things. And I don't know if y'all have seen these stories of these people that squatters just come in and move in and take over the house. So vacant houses can be an issue. So now's a good time to go see what you actually have. Now you might say, well, I'm a college student, maybe I should have renters, but I don't want to pay for it. You may be shocked how cheap renters insurance is. It's really inexpensive insurance and it's just peace of mind. Why is it so cheap? Because it's pretty low frequency. People don't rob apartment complexes. They rob, houses in the Dominican or where is it? What is it? Dominion. Sorry, Dominion. Yeah, Dominion. I get my countries and neighborhoods mixed up. But it can happen if you could have a fire, those kind of things, so if it's, a few dollars a year, it might be worth it. And you're also picking up liability coverage, which could be kind of nice. You break your neighbor's nose playing football, might be nice to have those kind of things. All right, I don't want to start liability here, but I do encourage you tonight, go home and figure out what kind of policy you have, maybe even bring the policy with you, and let's just see what we have. I assume we'll be here on Wednesday. If anything happens, it's whatever UTSA says. I don't decide those things. If we don't have class here, I'll do class by Zoom. I said that 2 years ago in the big snowstorm and I had no electricity, so I didn't do it by Zoom, but I'll do it by Zoom. So, but just watch whatever UTSA says. If you're worried about your safety and ice, all that, then just watch the class on Zoom. You can make up 2 or 3 of them on Zoom and not lose attendance.
All right, let's start. So we're on Zoom. Not the best situation, but hopefully you're warm wherever you are. It doesn't look like the weather's all that bad. Or hasn't been all that bad. Although up in Austin, it's pretty bad. We'll see what kind of auto claims and homeowners claims to get out of Austin. It looks like there were a few car pileups in Austin. I didn't notice the roads here. I don't know where y'all are, but I didn't notice the road. I saw trees frozen, but I didn't see. I rode my bike this morning and the roads were fine. I didn't see any major issues. But San Antonio is a big place, so no telling. It's interesting that Austin was hit so bad and we weren't. So it's, that's part of what we were talking about last time. A few miles can make a huge difference in the level of claims. So it'd be interesting to see if they have any claims estimates for Texas for this winter storm. I doubt it'd be anything like what we had in 2021, and I don't remember what the numbers were then, but winter storms can be a huge liability crisis, especially for repairing roofs and car damage and those type of things. So, all right, well, we're talking about homeowners insurance. If you have questions, unmute and ask your question. If you go on chat, I'll try to keep track of the chat, but I have a tougher time doing chat and going through the class. But so if you have a question, unmute, but try to stay mute just in case noise comes up. I got my cat outside. I'll bring him back in after the class. He was just starting my class last night. So we did homeowners insurance, the first couple of sections, and the second section, which is all the property coverage. So now we're going to do the last big section, which is the liability side, which covers a lot. It's a pretty general, pretty open-ended, covers a lot of things you may not even realize it covers. So you have coverage E, and then you have some special cases, medical payments to others, and so a few other things to look at. But coverage E, personal liability. So you do something, and we're going to talk about this later when we talk about general liability for corporations. But we're in the area of torts. So this isn't contract law. So you're not breaking a contract, that wouldn't be covered here. But essentially, you have a social contract to act in a certain way or not act in a certain way. And when you violate that contract and you cause damage, you have to cause damage, then you have a personal liability. And because of that, you can be sued. All right, who's second? I gotta find who's not muted. I can't tell. Okay. All right, sorry. Yeah, if y'all can try to pay attention, hopefully you're listening to us and hearing that you're not muted, because that's why I don't like Zoom. It's just too many things to try to coordinate at once. Not as bad as liability protection, doing something, breaking a tort. So what are your responsibilities? So those are the things you have a responsibility to act or not act in a certain way. You didn't fulfill that responsibility and there were damages. So if someone says, hey, you trespassed on my property. Yeah, so what are the damages? What did I do to harm your property? If there's no damages, then you don't have a liability. So there has to be damages. The damages are going to be stated in monetary terms. Doesn't have to be monetary losses for the other person. So pain and suffering, stress, those kind of things can be compensated with money, even if there's no doctor bill. So it causes property damage or bodily damage due to an occurrence of an event. An occurrence, that's where you get some tricky stuff. What is an occurrence? When does one event stop and another event happen? Bodily injury is you actually harm someone. You can cause someone to be sick or get a disease. Can include death itself. So, bodily injury, anything that is obvious harm to another person. Property damage can include loss of use, just like we saw for your homeowners insurance. We're talking about other people's property. So you cannot, there have been some cases on this, but you can't be liable to yourself for being negligent. If you are negligent and you drive your car into your own garage door and cause damage, you're going to cover that under the coverage, the property coverage of your homeowners. You're not going to cover it as a liability. And if you run out of coverage under your property coverage, you can't say, well, but I was negligent. So you cannot sue yourself. But there have been people who have actually tried to sue themselves for liability. Legal costs can be a really critical one in some of these. Mainly because legal costs are there even if the court decides you weren't responsible. You still have to pay your lawyers. And so you have to look at the coverage there, make sure you've got adequate there. That may be the biggest part. So an occurrence is a continuous repeated exposure to some general harm condition. So it it matters if it's one event or two events or three events because of the way the limits work and the way the deductibles work. So that can be important. That's probably a bigger deal on the commercial side, an event like 9/11, asking if that was one event or three events or four events or whatever. You know, if you're looking at an airline that might have lost two planes, was that one event or was that two events each one? So it's rare that that's an issue, but there are cases, especially on the commercial side, where that becomes really incidental to millions of dollars. The insured is the insured, a relative, you know, kids that live in the house. So your kids can cause liabilities. They're so covered. You have hired hands on the property that are, you know, doing stuff for you. Hopefully, if it's their business, like a lawn care, they have their own insurance. Others on the insured property that are using your property with permission. So it can cover more than just yourself. You're hoping these other people have their own coverage. But if someone causes harm and you gave them the permission, you told them to do something, and that liability falls back on you, even though you didn't commit the act, you can't have coverage. And it covers people who do favors for you, unless that favor is their business. So if you ask your neighbor to take care of your dog for you while you're on vacation, any damage that your dog does would be covered. Your neighbor doesn't have to go out and get insurance to cover that, unless your neighbor runs a kennel and you're leaving your dog with their kennel, even if they don't charge you. That's their business. They should have their own insurance. So and the animals are a big part of the liability that you see on these types, especially dogs biting, mainly dogs biting people or getting loose and damaging either a human or another dog. All right, so there's liability. We'll talk when we get into the general liability, how much is enough to cover you, because that's a big question. And we'll see that here pretty quickly when we get into medical malpractice reform. Coverage F is really just kind of making sure you don't make bad decisions in the middle of a crisis. So it's rare this coverage is ever there, but essentially what it's saying is someone gets injured on your property and you might have been responsible, but you don't know. And so you call an ambulance, they take them to the hospital, and then your insurance company says, no, you weren't at fault, it was their fault. And they don't have medical care and you pay for the ambulance. Now you're out the money and you're not covered because your policy didn't cover you. Well, the last thing the insurance company wants you to do is say, well, you know, I don't know if I'm responsible. So I don't know if I want to call for an ambulance, because if they show up and it's $1,000, I got to pay that $1,000. The insurance company says, just take care of it. Assume it's your liability, take care of it, and then we'll cover that at the end. If you end up being liable, then the coverage will be under coverage E. If you're not liable, but you did it in good faith and there's no other funds to cover this person, then you're covered under coverage F. I don't really like this stuff. You can find one of my biggest problems, especially when we talk on auto insurance, is I don't like it where we keep throwing medical insurance in all these policies. Medical insurance can cover medical insurance, and everybody should have their own medical insurance. And you know, then if you're liable, then their health insurance company can come after you to get reimbursed. But yeah, we'll see that. It's a bigger issue on auto insurance. I just think we keep paying for medical health insurance in several different products all over the place. So what's covered? The injured party has permission to be on your property. So trespassers, if they get injured and you have something that, you know, that harmed them, you know, they're on their own. The injured party is not on insured property, but an injury arises out of something related to your product, your property. So maybe your water hose is on their property and they trip over it. Or let's say you're out at the neighborhood playing football and you injured a neighbor, so you don't even have to be on your property. So that's kind of the nice thing, is this covers you again anywhere in the world. Resident employees, on duty but off premises, and then your animal bought off your property. So yeah, you get quite a bit of coverage here. There are exclusions, but most of them are pretty obvious, like intentional. If you intentionally do something to somebody, especially if it turns out to be criminal, business activities just are not going to be covered by homeowners. If you have a business, some people think Airbnb or I got a daycare center, I babysit kids. It gets tricky. If you're babysitting one kid every few weeks, maybe not an issue. If you got if it's a big part of your business, I don't know when it goes from being like a hobby that wouldn't be considered a business to being a business. But if you're doing something like that, call your insurer. You don't want to just assume you're covered and then you find out afterwards that you're not. Costs, and of course, a business engaged, you expect monetary gain. It's some kind of continuous activity. Rental properties are not covered. This is the Airbnb can come in. Some people, they live on their property, but maybe they take an extended vacation. And when they do that, they do Airbnb, they're rented out. I'm not an expert on that, and it probably varies state by state. So, just be real careful. If there's something in your property and it causes harm to a person renting out and they're going to now sue you and you're assuming your homeowners are going to cover it, you're in a different world when you start renting something out. Professional services obviously are not covered. If you're performing surgeries in your living room, or your lawyer, accountant, those kind of things, we're going to talk about professional, kind of malpractice type of insurance. You're not going to get any coverage for that in this policy. If you're not in a insured location, here the real question is, should it have been insured? So you are covered anywhere in the world, but there are some exceptions. You can read through those. I don't really care about the exceptions here. I'll just let you know there are times where you can be somewhere in the world and have a liability, and the insurance company is going to say you're not covered because you should have had that covered. So you might, if you have that type of issue, you have other property or whatever, you may want to check with your insurance company. All right, I'm going to skip down because the exceptions to me are not that important to this guy. I just want you to be aware there are exceptions, and then there are exceptions to the exceptions. Motor vehicles are not covered because that's why we have auto insurance, unless it's just some incidental, like a parked trailer or some golf cart course you only use on the property, wheelchairs, riding lawnmowers, those things that are obviously not built, not intended for regular roads. Watercraft, any liability you have operating a watercraft, you need to get specific insurance company for coverage for that. Same thing for aircrafts, obviously. War is at exclusion. It's hard for me to think of. I mean, if you're involved in a war and you're liable, you cause damage to someone else, I guess they could sue you. I don't know if there's cases out there. The two soldiers, I guess, friendly fire and those kind of things. I'm not aware. I don't know if any of y'all are aware of a lawsuit where someone was hurt or even killed in war, and it was because of the negligence of another soldier where they actually got sued. That would be interesting to see. But if that's the case, their homeowner's liability will not cover that. There are some exclusions that are not covered for communicable disease that you need to be careful. You're probably okay for like food poisoning. If you accidentally give someone food poisoning, that should be covered, unless it's kind of intentional, obviously, if you're poisoning someone to get insurance. Criminal activities are not covered. Now, there are some things that can be criminal that could be covered. So trespassing can be a criminal offense, but it's also covered here. So, I mean, it's possible it could be both a tort and a criminal offense. But if it's simply a criminal offense, you're selling, you have a meth lab and you're selling meth, I guess that would be a business too. But whatever, anything that's a criminal offense, and that's where the daycare at your house can be an issue if there's someone that's a family member and there's some kind of mental or sexual abuse. You got to be really careful. So that's, again, you got to be just completely honest with your insurer. Workers' comp is always an exclusion with these, just like with war, nuclear energy. I'm not so sure how, and that's kind of interesting, how you could be under a homeowner's policy, be negligent related to nuclear energy that would not be part of your job or a business. I don't know what you guys might be doing out there with your plutonium, but yeah, that's kind of a catch-all that hopefully has not been needed. All right, exclusions that are only relate to the liability side, contracts. If you have a bad contract or you violate a contract, that's what contract law is all about. And that's the purpose of the contract. The purpose of the contract is to assign liability. That's the homeowners insurance is not going to cover you there. You can't be liable to yourself or your own property. Care, custody, control, property damage, your property rented to, occupied, or used by an insured. So you know, there's certain exceptions that apply very rare cases, but you just want to be aware of them. And bodily injury to yourself is not covered. Other coverages you can get here, obviously your claims, legal costs, premiums, expenses for when you lose work, interest, first aid expenses, obviously damages to property of others. Even if you're not liable, you know, there's some exceptions in here, and all of these exceptions generally have a specific case law case related to them. A lot of this is added over time as a case law comes up, and the insurance company goes, wait a minute, that's not what we intended, or the courts decide that is what's intended and they have to add the language. So when you see these really, really, really specialized exceptions, there's usually one particular big case related to it. We're going to talk about one here pretty soon. We talk about mold in Texas. And then we talk about loss assessment. I think loss assessment is more likely on the liability side than on the property side. So if the board of your homeowner association votes to not hire lifeguards at the pool, and they get sued, and they charge all the residents, you know, $500 for that lawsuit, then you would have some coverage there at the sum limit. Really, the key for me in liability is to think through what's covered, what's excluded, and try to think, do those exclusions apply to me? Am I doing something that exposes me to loss that is not going to be covered by this policy? And should I buy a separate policy, or should I stop doing what I'm doing? That's the much smarter way of doing it than just say, well, I sure hope my policy covers it because I don't want to pay the higher premium. That's just not a good way to handle insurance. All right, so what's actually covered? So you got the basic, the broad, and then the all risk. So the basic, you read the list on the basic, and most of this applies to the property side. So we're jumping back really to the property side. Most of the basic, I think you'd say, yeah, that's the coverage I want. That's what I'm worried about. Fire, lightning, windstorms, hail. Boy, we've seen some big hail. I saw videos from Dallas. It looked like snow, but when you actually look at it closely, it was just ice falling from the sky. Not the fun kind of stuff, not soft and pleasant. That can do some pretty hefty damage to a car. Hail can do some damage. I've had a car with hail damage, and boy, it's expensive to fix that. Explosion, civil commotion, an aircraft. So if a plane part falls and lands on your house, vehicles. So I'm not talking about your vehicle, but someone else drives their car into your property. And there are some places, there's a really famous place. I lived in North Austin. There was a famous place in Pflugerville that was on a corner near a lot of bars. And so there are a lot of intoxicated drivers, and that car had been driven in, that house had been driven into multiple times. And they finally put a massive stone wall in front of the house. They just got, it was scary for them. People were just driving right into their house. So yeah, that's covered. Smoke can be covered even if there's not a fire. If your neighbor is burning leaves and the smoke comes over. Vandalism, malicious mischief can be covered. Now, I don't know, you know, I think I had a couple of students think about doing paper 2 on 2020 with the George Floyd riots and some of the property damage from that. I don't know if that's enough of a topic. So it's, you know, it's an issue because that's something insurance companies worry about because that's one of those things that could hit a lot of property at the same time. But there might be something there. I doubt it would be enough for a paper, but maybe combined with another thing. Theft is covered. The question is, was it stolen or was it lost? Lost things can be covered as well. But if you're claiming theft, they're probably going to want you to get a police report and report it. But this is where you need to have, if best as possible, some proof. So video your inside and outside of your house, video inside your car, what things you own that not part of the car, but just sitting in the car that might be covered. Have quite a bit of detail. And it's so easy now to do a video like that and just put the video like on a Google Drive somewhere you have it handy, maybe do it once a year, maybe make a game out of it, you know, have your kids dance around, do something, you know, it could make it fun, but something where you know exactly what you own, all your clothes, your appliances. So try to have some kind of proof of what you own. So it's covered anywhere in the world. So you want to make sure that, you know, wherever that you have it. So if you have stuff stored in a kind of a storage, like some of these storage facilities, make sure you know all the stuff you have. A lot of these storage facilities, I had one, I forget the name of it. It's the last time I used a storage facility, but they required me to buy insurance. And it was inexpensive. And so I just canceled. That's when I canceled with them. Because like my opinion was, I'm more than adequately covered with the homeowners insurance. I don't want to have to pay, but they were making money on that. And so they were requiring people. And I was thinking, why am I spending $1,000, including insurance that I already have, to store stuff that's not even worth $50? It was just a waste. I was storing stuff I just felt guilty throwing away. So I just gave it away. So be careful when you deal with some of these people. We'll talk about that with rental cars, but with storage sheds, a lot of people make most of their money off the insurance. And so they want to sell you the insurance, and you may be fully adequately covered by your homeowner's insurance, and you're just double paying, and the insurance is grossly overpriced, which is the reason they're so eager to sell it to you. And this particular place refused to let me decline it, which I thought was probably not. I probably could have challenged that in court. I don't think they can force me to buy insurance. But it's interesting. So on theft, make sure you have the documentation. Volcano eruption is covered, but earthquake is not. So, you know, earthquake is a much bigger issue than volcanoes, although volcanoes can cause the earthquake. You can get earthquake coverage through an endorsement. We'll talk about that with California. Most people in Texas don't have any coverage, even though we do have fault lines here, so it's possible. Now, what does the broad add to that? And it's not much, although I learned about one of these today on my bike ride. So falling objects and the weight of ice and snow. I was glad I had my bike helmet on. There was some ice in the trees, and one was on the electric lines. And boy, it just all fell at one time right in front of me. It didn't hit me, but it was just inches away from me. I don't know if I hadn't had a helmet, if it would have caused damage. It didn't look like it was particularly heavy, but it was some pretty sharp pieces of ice. That can cause some damage, falling objects, snow, sleet, those kind of things. Accidental discharge or overflow. Now, this is a key one. I want you to remember this one because we're going to talk about mold in Texas. Most states, for this accidental discharge, it's covered, but usually within a very strict time limit. The problem that for Texas was the time limit for the damage was essentially ill-defined. And so people might have a water leak and it caused mold 5 years later, and now their whole house is getting gutted and rebuilt. And now there's tens, if not hundreds of thousands of dollars in damage. And it caused a huge issue in Texas. And I want to cover it because it's a really good special case. I'm trying to think what the next thing would be related to that. We're going to talk about storm surge and some others. But this is the nightmare for actuaries, is something like this comes up and suddenly it's billion-dollar claims are coming in for something the actuary had no idea that could ever happen. And this is one of those. For some reason, the state of Texas, their policies are worded slightly differently that allowed some pretty massive lawsuits and some claims. Accidental tearing apart, cracking, burning, y'all can see that. Freezing of appliances. So, you know, those can be covered, you know, burst pipes, those kind of things. Cold weather, especially in Texas and South Texas, we don't always handle that well. Power surge was a big issue, probably 20 years ago, mainly because personal computers were $1,000, $2,000, $3,000. The last PC I bought was like $200. So it's not as big of an issue, but people used to worry a lot about power surges with their PCs. And I think the PCs themselves are probably being built better to somewhat control that as well. I haven't had that issue. I use power strips to try to protect myself some. So there were some policy exclusions with that, but I haven't heard that issue raised at all. I don't know if that's an issue any of y'all worry about, but that was a huge issue several years ago where people were just really, really paranoid about power outages with their computers. Some general exclusions just for the property coverage. The government can do things that will not be covered. Earth movement, earthquake is not covered. You have to cover that by endorsement, and that includes stuff following later. So you have to be careful what is covered, what's not. So the earthquake is not covered. What about the fire afterward? What about the theft afterward? What about the flood afterwards? So you have to think about what is covered, what's not. A lot of things are covered, but there are some special things that are not covered. Flood is not covered. We're going to talk about that when we talk about storm surge and the special issues related to mold and those kind of things. Power failure, unless it's now just power outages, unless it's due to a covered peril. Neglect, if you're just not taking care of your property and that causes damage, that's not covered. War, again, is not covered. A nuclear hazard, again, is not covered. We saw it on the liability side, doesn't make sense. I could see nuclear hazard maybe being an issue on the property side. And then intentional loss, you can't destroy your property, burn it down to get the coverage. And then there's all risk. So all risk just means we cover everything unless it's excluded. And you can kind of guess what those exclusions are. So it's maybe a little, probably real similar to exclusion you're seeing already. So let's say you have a loss. So how much is the insurance company going to pay you? Well, it's real important to know that they're not going to pay you more than your limits. So start with the limits. So if your house is worth $1 million and you have a $600,000 policy, you're already underinsured, definitely. So how do you cover it? So you could get actual cash value. That doesn't apply to the house. That does apply to the personal property. So actual cash value is how much it costs to replace the item minus normal depreciation obsolescence. So if you have a 20-year-old TV set and it gets stolen, you don't get to replace it with a brand new state-of-the-art TV set. They're gonna replace it for whatever essentially the blue book value for it is, which could be $50 or nothing, depending on what kind of you should have seen the TVs I had when I was a kid. My word, they were massive. They were 2 feet deep. Those things wouldn't be paperweights today. They're not worth anything. So replacement costs takes out depreciation, takes out obsolescence. That's for your personal property. For your house, we use what's called replacement costs, which means the cost to replace. And the reason for that is if they paid you actual cash value, so you have a $700,000 house, but it's depreciated $300,000. So they're going to give you $400,000. Well, you can't rebuild your house with a used house. You can't replace your 20-year-old house with a 20-year-old house. You have to you have to replace with a new house. You're stuck on this piece of land. You can replace a 10-year-old car with a 10-year-old car. That's possible, but you can't replace a 10-year-old house with a 10-year-old house because you're on that property. You got to build on that property. And so replacement cost makes the most sense, but it does set up some moral hazard where people, almost have an incentive to burn their house down because they're going to get a brand new house. And so the insured definitely, that's always going to be an issue. There's a little more morale hazard with this product because of that replacement cost. That on car insurance, it's actual cash value. That's what you get. You may have seen Liberty Mutual advertising that they actually have replacement costs on cars. That sounds too good to be true. And if you read the fine print, it's really not as great as it sounds. But you just, on auto insurance, you definitely don't want to do that. Someone would definitely want to replace a 5-year-old car with a brand new car. That'd be great. You can get it all covered. The morale hazard on that would be far too great, and moral hazard. But on housing, because of just the nature of housing, because we really can't replace a 10-year-old house with a 10-year-old house, it's a little different. However, you have to have a certain amount of coverage or the coverage limits will change. So here's a case where you might have partial damage to your house well below your limits, but they don't cover it all. And that's because you didn't buy enough insurance. So essentially what they're going to say is, if you have $1 million house, you should have bought at least $800,000 of insurance. Now, if the entire house is destroyed, they're only going to pay you $800,000. But where that $800,000 becomes important, that is, if one room is damaged and that costs $10,000 to replace, but you did not have enough insurance, even though your limit is $800,000, they're going to cut how much they pay you depending on how much insurance you had versus how much you should have had. Which means you do need to check on your policy and make sure that your amount of coverage is adequate for the value of the house. And we've seen housing prices really soar the last few years, which means replacement costs has also soared with inflation and other things. So it's probably not a bad idea to double check your valuations every once in a while. This is an area where, it's almost the opposite of what I did with the rate online. Here's one where you might be surprised adding an extra $100,000 to the property limit might not cost you that much more, but give you peace of mind that you've got enough coverage. But that's something, check with the insurance company and see. There are inflation guards, endorsements. I'm not sure exactly how they're structured. I've not seen one of those before, but there are ways you can try to get it so that you don't have to check every year. It just does an automatic adjustment for you. So the policy will never pay you more than your limit. So whatever you put the limit on, if you didn't buy enough insurance and the whole house is torn down, you're out of luck. The cost of repair, they're not going to pay more than that. If they can repair it cheaper than other ways, then they're going to do that. So, they're going to look at what you have and they're going to replace that. Now, there are some exceptions. You may have something really unique about the house, or maybe building codes have changed. So you're going to see some exclusions where they don't have to rebuild your house exactly like they had it. If the laws have changed or you had something that was hand carved by some artist, those kind of things, they're going to do the best, and the contract's going to tell them when they have an out. As far as the 80% test, I don't really care that that. That's something you can figure out on your own. Just make sure you have enough tests. The formula is in here if you need it, and you can look over it, but it's really not important to this class. Just know you need to make sure you have enough coverage. In this paragraph, just what I was talking about, the insurance company doesn't have to replace it exactly like it was. So there's a best efforts to get as close as they can, and some things are just going to be unreasonable. All right, so there's how the property is covered. We'll talk a little bit more about personal property here, but so let's say you've had a claim. What are you responsible to do? So obviously you got to call the insurance company, you got to call the police if there was theft. If your credit card was stolen or lost, you need to make sure you cancel the card there, although the bank's probably going to cover most of that. You need to protect the property from further damage. You can't say, it's already done so much damage. I'll only leave all the doors and windows open. I might as well get this to be a total loss so I can get everything fixed. You can't make those kind of decisions. You need to prepare an inventory of the losses. That's where having the video is really going to help you. You have to file some kind of statement. That may actually be electronic now. The insurer has the right to inspect the property and see how much damage their average actually was. That's where adjusters come in. And definitely keep your proof of ownership if you can. I'm really bad at that. I keep receipts and those kind of things, but then I need them and I can never find them. I needed a receipt for my, I bought a new air conditioner. I needed to find that receipt, and I knew I had it, but I just kept searching and searching. So I need to get better organized. You probably do want to get better organized. If you ever spend more than $500 on something, I would create a file cabinet and keep those in place, or even better yet, what I should have done. And I just got to get in the habit of it. Anytime I have an expensive purchase, maybe on Amazon or something, take a picture of it, put it into a file, put it out there on a Google Drive, and just add to that file. So I have everything in one file, and maybe even kind of with words that I can search on, just so I know it's all in one place. My current filing system's not good. It's the kind of thing where we don't think about it, and then when we need it, we're just irritated because we can't find anything. So, and then you may actually have to go on the court under oath to say certain things that, if you lie about it, could be a felony. The insurer does have the right to repair and not replace, rather than give, and they don't have to give you the cash for the item. So they have some options that are in the contract. If your house has a mortgage, the insurer is going to write the check to the mortgage bank. If they do write a check, if it's a total loss and do have to write a check, they're going to write it to the bank and not to the person that owns the house. All right, what kind of endorsements can you get? So personal property is the big one. You have some special kind of thing that's expensive. All right, I see there's some chats out there. Let's see if I can find them just a second. Yeah, Damien, that's essentially what I'm saying. Yeah, email it or create a Word document with the pictures of them all with the price. Yeah, that's really good. The key, I think, Damien, you probably agree with me, is the habit and the process. Get started and be really precise on it, and just do it every single time, because we kind of get into the hectic nature of the day, and we let it slip once and twice, and then finally we get $10,000 of stuff we haven't documented. All right, so the personal articles floater it provides all risk coverage except for wear and tear, insects, and nuclear hazard. It has a separate policy limit. So you're actually, it's not part of your homeowner's policy. It's a separate limit. So if you do have it scheduled, it completely gets excluded from your homeowner's policy. It's covered anywhere in the world, except for some reason, a lot of policies, artwork is only covered in US and Canada. It pays actual cash value, doesn't pay replacement value, although you can get replacement cost endorsement. So fine art is an interesting one. So you've seen this on Antique Roadshow. It really is. It's almost like life insurance. With life insurance, you just decide how much your life is worth, and you just go buy that much insurance. So the same thing here is, you and the insurance company, you just somewhat decide, or maybe you go to Antique Roadshow and they tell you what the insurance value is. You just decide what that value is. The insurance company is going to be worried about moral hazard or moral hazard, that, if you put too large of a value on something, that can create an incentive to destroy it. But fine art is a tough one, because if the artist is dead, you got a Rembrandt or something, a Van Gogh, there's no replacing that from a fire. Hopefully no one's storing something that valuable in just a regular house, but cash is about the only replacement. The only exception I thought was a pretty cool story when I was working at UTSA. A family, I think it was a fire, they had a piece of art got destroyed, art stolen, but I think it was destroyed. The artist was still alive. And so what UTSA did was they contacted the artist and they commissioned him to paint a new painting. And the insurers were fine with that. which it was even better because they bought the painting in like an art gallery, and here and now they have the artist painting a painting just for them. So it created a story for them. I thought that was pretty cool. So, it's possible if the artist is still alive. I hope they like the piece of art just as much as the one they had before. It would have been awkward if he painted a really bad painting the second time. But pretty cool. USA worked that out, and I don't think he even tried to replicate the original artwork. I think he gave them an entirely new work of art. So, but there are some places, it's tough. There's certain things that are just not replaceable. And in that case, they become a valued policy, which means you just decide on the money amount. And if it gets lost, you're just going to get cash and you've lost the item. So personal, you can get replacement cost endorsement, inflation guard endorsement. You can get the earthquake endorsement. So all these things, these endorsements that you see under the regular property coverage, you can get that here. So there's your homeowner's policy. I don't know if any of y'all have your policy in front of you, but again, think about what is it in this policy that you think is covered that may not be covered. And is that important to you? Should you do something different? Or if there's something you're doing unusual, call your insurance company. I know this is something really important on auto insurance part B and C. I like to do scenario analysis. Hey, what if this happened? What would the policy do? Just start thinking wild, going really way out there on a limb. Not that you think that thing's going to happen, but really fully to just understand the policy and just see what's going on. If there's any court cases on that, those kind of things, just try it the best you can. You might ask, wow, I like to rent these mobile skateboards. And wow, I brag on Facebook all the time about how fast I drive these things. What if I hit someone and really harm them? Is my homeowner's liability going to fully cover me for that? How much coverage do I have? Is the fact that I'm bragging about this on Facebook going to mean that I'm going to have this massive lawsuit? Think through things that you're doing, that property that you have, you don't want to lose. It'd be really expensive. Things that you're doing that are dangerous and you're bragging about it in social media, that if you did have a mistake, it could cause major damage. Those kind of things to think about. So, we own stuff, we just don't think about it until the claim happens. And then we're like, wow, I wish I had talked to my insurance company more on this. I do remember once being on a plane and the passengers across from me, they were looking out the window because they were loading the luggage, and they had a very expensive set of firearms. And they actually watched their firearms being thrown onto the plane and falling off of the conveyor belt and falling on the concrete. And those guys were about to scream. They were screaming. They were really upset. But they witnessed the whole thing. This was before cell phones, so they couldn't get a video of the whole thing. But if you own expensive stuff and it would devastate you if it got lost, make sure your policy is adequately covering you. Don't want to add to your stress by you lose the item and then you discover you have no coverage, and you're like, that's like double stress all at the same time. All right. Any comments, questions up to there? I don't know, Damien, if you work in this industry, if any of y'all work in this industry, I don't have the sell side and the claim side. So a lot of this is textbooky for me. And I know each state has some special cases that can be really interesting. So if you have any background, just let me know. Certainly throw it in there.
Yes, sir. I am a sales agent as well. So all the PNC stuff, I've pretty much taken care of all of it. Currently, I'm a life insurance specialist. So,
Okay.
but all those things you're talking about are completely true. And you're speaking about how you said take pictures of your stuff. That's actually one of the biggest items, because people don't think about or consider soft fraud. Just lying about, oh yeah, that was there too. It not actually being there. So, but those claim specialists are really good at what they do. So, SIU is no joke.
Yeah, I hadn't thought about that. I would think someone would forget they own something and not report it, but I guess it wouldn't actually be, immoral that they thought they had it and didn't and reported it. And yeah, I guess that could happen too. Yeah,
but that's actually very common too. What you said in regards to forgetting, that happens a lot. I always tell that to members the biggest thing is they're going to pay you for to indemnify you. But if you don't remember it, then you're not going to get that payment for it.
Yeah, yeah, and we buy so much junk. I live in a small condo, so I can't buy a lot of junk. I just have handled people, when a parent passes away and, it's 9 months to get everything in order, this stack of junk. Yeah, I've probably seen the TV show Hoarders, which is just incredible. So, maybe the solution is we stop buying so much junk, but we buy so much, it's easy to forget what we purchased. So yeah. All right, great. Thanks, Damien. All right, so flood insurance. I'm sorry?
I just wanted to ask you, I'll ask you after class. It's fine. It was about property. It was about property insurance. I just wanted to ask you about a scenario that I've heard. I don't know if it actually has happened. Can I just ask you right now then?
Yeah, you can.
You heard of stories where someone breaks into someone's house and then they slip and fall and then they sue the owner because they slipped and fell in their is that happen? Is that just like a myth, or does that actually can that happen?
That was somewhat what I was talking about, trespassers. So I know there have been cases like that. You do have to be careful if you make your property intentionally dangerous for things like that. You can have some issues with that, and then you just got to be careful. You can't intentionally booby trap your house because people are trying to break into it, and that can be pretty dangerous. But if someone breaks in, I think I've seen a claim here just in the last 3 years where someone has done that. I have to look and see if I can find an actual case law on that. They're usually not very well received by the public. It's usually, you assume the risk if you're a thief, and even if the person's negligent, but booby trapping is a different thing. So if you set up booby traps on your property, pits with sharks and spikes in them, that gets you in a lot of trouble, and that could even be criminal negligence at that point. So you got to be careful there, even with the trespassers. So you have to at least be aware that people could come onto your property, even trespassing. If you have stuff that, it's their fault because they came on your property, that's fine. But booby trapping is different. But I'd have to look, that's why I love business law classes, because you get into some of these really interesting cases, and there are a lot of them with insurance.
Yeah, because the thing is, I remember I took the concealed carry class a long time ago. They said if someone breaks into your house, of course you can defend yourself, but they'll look into it where, oh yeah, he broke into my house because I owed him money, and they'll look into all that stuff, you know what I mean? So yeah, that's a whole different, I know property insurance, but thanks.
If I can find a case like that, I mean, there's some really interesting cases out there. And we'll talk about some of the fraudulent cases that are out there as well.
Right. Thank you.
All right. So flood insurance, you're not covered by flood. We'll talk about this a little more when we talk about storm surge. You can buy a policy from the federal government. So it's been around a very, very long time. It was a huge deal in Hurricane Katrina. We'll talk some about that. Actually, a very, very interesting case related to State Farm after Hurricane Katrina. But it's managed by FEMA, which FEMA, got a lot of press after Katrina for bad reasons. You'll buy it through an insurance company, but they're selling it for the federal government. And they pay the claims, they collect the premiums, pay the claims, and then the federal government essentially protects them. I remember at USAA selling flood, USA was adamant that any money related to the flood program was always segregated, always protected, no mingling of that money. They were real specific with that policy because of the government and the way it works. So they everything in that program was very to itself, its own department. All of its expenses were closely followed. Insurance companies like selling this because it allows them to take care of their customers' needs all in one place. They don't have to tell them, oh, you got to go call the government for this, but it is not their policy that they're providing. For communities that are part of these programs, they can apply to it, or if FEMA determines that their area is flood prone, there are certain things the federal government's going to come in and require them to do. And it's actually been a lot of people think very beneficial. that it has created some of these river docks and other things, things to keep water levels at protected levels. So we've actually improved the safety of our rivers over time. Obviously, massive floods, there's not much you can do there, but even those, there's probably less damage in certain places. But FEMA, that's part of their job, is to make sure we're not building massive communities in an area that gets under 20 feet of water every 50 years or so. So you would probably buy on a regular program, because I doubt any of y'all are in one of these emergency areas, special flood hazard areas. If you're in a special flood hazard area, there's restrictions and premium differences, requirements that you have to do in the area. Obviously, you don't want to move into a heavily flood prone area. There are times though when people move and they check all of that and everything looks fine. I was watching a podcast the other day. They did all the work, they did the research, they discovered everything is fine, and then the government changed their mind and said, no, this really is a flood area. And suddenly they were restricted in what they could do. They actually were supposed to move their house, and that was going to cost them more than the house was worth, and it'd be frustrating. So that's something definitely when you're buying a new house or buying a plot of land, is to ask those questions about where's the nearest waterway, what happens when it floods. Floods are unusual. I was in the major flood in Austin before you guys were born. We were on a hill, on the top of a hill, or on a way down a steep hill, and we were thinking, flood's not an issue for us. And I remember my brother going out in the backyard and noticed that the water was starting to pile up. I actually noticed it first. I went out into the garage every once in a while, and every time I went out, our dog was closer to the door. And the last time I went out, we had 2 inches of water in the garage, and the dog was, no, it was before 98, because I was still in Austin, so it was in the 80s. So the dog is got her body up against the wall because there's no place for her to stand. And I'm going, that's strange. It's like it's flooding. So we go out in the backyard, and it's deep in the backyard. So my brother decides to jump over the fence, and our neighbor's backyard was a swimming pool. I don't mean they had a swimming pool. Their backyard was 4 or 5 feet of water. He splashed. And what we discovered is, yeah, we're on a hill, but these privacy fences, they're like dams. They were holding the water in because the water was rushing so fast. It could not get through to get down to the creek. So we just started knocking the fence post out. Our house did not get flooded, but our neighbor's house was completely gutted. So you might assume, hey, we don't have to worry about flood. I don't flood, but water, you get these unusual flood, heavy rains. That's when you discover where the water is going to run, where it's going to go, and you might be surprised. So I know a lot of people don't have flood insurance. The guy I think I told you about before, who always was wiping his feet before he walked into his house that'd be flooded. His backyard had a creek in it, a major creek. It should have been obvious that he would need flood insurance, but he didn't. The program does not cover anything that your homeowner's policy covers. I think the biggest issue here is the limits. If you own a $5 million house on the coast, you're just not going to be able to get enough insurance. It's just not going to cover you. Yeah, I don't know why people want houses on the coast. They're so expensive. I don't like the coast to begin with, like salty water, but I'd rather take that money and just travel down there a few times a year and rent, a 5-star condo up high on the beachfront. I don't want to actually live there, but I know some people I guess it's really romantic to be actually on the coast. There's a few people, I might have told you all this story before, but it just shows you water is very powerful. So you might think, I've done everything so I don't have flood insurance. So the coast of Texas are putting their houses on these massive concrete blocks, 15 feet up, thinking that's going to protect me when the storm surge comes in. It won't be 15 feet. And it's true. The water didn't get up to their first floor. But when another house comes floating by and runs into your concrete blocks and knocks your house down, you got the same issue everybody else has. It's so powerful. And when you have actual houses floating around, that's a lot of weight, a lot of power. So my best solution for flood is just don't take the risk. Don't live in places where that's an issue. On the coast, especially if you live on the coast of Texas, it's almost inevitable. You're going to have some major event that's going to happen to you. Just rent the place and enjoy it while you're there. All right, so this next one, it's not a big deal. This next one is a much bigger issue for auto insurance, but just real quickly, this industry has an issue, and we'll see it when we talk about credit scores. This industry has an issue with what some people call redlining, where you don't sell to certain neighborhoods just because they're higher crime or heavily urban. And there may be certain people groups that are just not able to get insurance because of these policies. And so there's programs in place to try to provide good basic property insurance to these underserved areas. And so there's one called the FAIR plan. Each state might have their own plan. We're going to see on the auto side, it's just a lot more plans. And essentially what they do is the insurance companies are essentially assigned these policies based on the percentage of how much they do business in the state. So obviously State Farms can get a bunch of them. They usually lose money. I remember looking at UTSA losing $50, $100 million on these type of programs. So they are subsidized. For something like this, you're subsidizing people who should be paying higher premiums because it is a high crime area, but they can't afford to move in a lower crime area, and they're not criminals. They're good, decent people, and the government's saying, hey, people got to be able to live somewhere, and they need to be able to have protection. So that's part of this. When governments subsidize homeowners so they can build their houses on the coast, that to me is a different thing. Subsidizing people so they can build their expensive houses in a very risky area, that doesn't serve the taxpayer well. So I don't like those type of programs. Say, wow, people can't build their houses on the coast of Miami because homeowners insurance is too expensive. Well, it's expensive because it's a dangerous place to build. Let's don't subsidize these people. I can see the argument here. These are people who need to live their lives. They need this type of protection. So maybe there's a good societal argument for that. I'll talk on the auto insurance. I'm not sure on auto insurance that doing our best as a society to make sure really dangerous drivers can get auto insurance. I'm not so sure that's a good idea, but these programs are probably not that expensive. I think the programs I've seen where insurance companies are losing a lot of money are primarily on the auto insurance side. So these are probably not that big of an issue. Now, some states are insurance companies. They have their own earthquake pools or wind pools. So for the state of Texas, we have TWIA. I don't know if you've heard of TWIA. It was a huge part of the political scene a few years ago. But TWIA is essentially a state-run insurance company that's funded by insurance companies. If you need a topic for paper 2, this might be a good place to go to try to find some information. They may have some links to some interesting things. There's probable maximum loss. You see that down there. We're going to talk about probable maximum loss here pretty soon. So essentially what it is an insurance company that insures people within a certain number of miles of the coast of Texas. Now, this is a big political issue several years ago because it was obvious TWIA did not have enough money to cover a major hurricane. And so what the state of Texas decided was, we'll handle that by not having any major hurricanes for the next several years. That was their plan. Now, I don't know how they were going to get that to work out. But essentially what they were doing is like, let's just hope it doesn't happen. Let us build up with premiums, get enough money in. Let's just hope there's no major hurricanes, because they just couldn't think of a better solution. I think they're in better shape now, so it's not as big of an issue, although this does come up in the Texas legislature every year, or every time they meet, I guess every 2 years, as a major issue, a lot of debate, a lot of discussion. Obviously, the people who represent these districts, this is a major issue they're going to bring up. They want to make sure their their residents have insurance and that it's not too costly. And then the rest of the states wants to make sure that the Texas taxpayer doesn't end up having to bail this thing out. So California has something like this, Florida, Hawaii. There's places that have these type of state-run pools just because it's something that the insurance companies don't want to cover. It's too expensive. And so essentially the state says, we'll force you to cover it by creating this pool that you have to fund. I don't know if any of y'all live on the coast and know if you or your parents have TWIA coverage or not. It'd be interesting. I've never had that issue, so I can't tell you any personal experience with that. It looks like an insurance company when you go on to their site. All right, now another special case with homeowners. Let's say you look at homeowners and it gives you $300,000 of coverage for liability. And you think, wow, my net worth is a whole lot higher than that. I need a lot more coverage than that. And you call and your homeowners, no, that's the most we'll give you is 300,000. And so, or 500,000, whatever. And you say, well, can I get additional coverage? Well, you can buy an umbrella liability policy. So if your net worth is well above the limit, the liability limit of your policy, then this is the type of policy you'd want to get. You can get it. It covers anything, not just home related, but also auto related. Auto is probably the more important one because we create a lot more risk on the auto side. It's essentially catastrophic liability coverage. So, I think if I'm driving, I remember in Houston once I was driving and I thought I was paying attention. I'd drive out of a fast food restaurant, turn right, didn't realize I was turning onto a one-way street. There just weren't many signs up anywhere. And I didn't hit anybody. Fortunately, there was a car coming right at me, but he saw me in time and just honked at me. And he was actually pretty nice about it. He's like, hey, man, you're going the wrong way. But you think about that. What if I turn right into a school bus with 40 kids on it? These can be, and it was a busy street, 45-mile-an-hour speed limits. So, when we're driving, we're out there driving 50, 60, 70 miles an hour with a ton of steel with a bunch of other people. And it's not that difficult to get up to $1 million, $2 million, $3 million in claims. And so these policies, and they're fairly inexpensive because we're talking about a pretty rare event. So you get a lot of coverage for very little pay. In fact, what I did when we talked about me canceling Part B and C in my auto, that's what I did. I canceled B and C in my auto, and I took all of that premium savings and I bought an umbrella policy. So it's nice, and it does cover some things that auto and homeowner don't cover. So there can be some things there that are important. There's some issues about settlement and defense costs that you want to make sure you understand, because defense costs and these kind of massive claims can be a big part of the cost. You are required to maintain your underlying liability coverage on your homeowners and auto. So you can't just say, well, I'm going to cancel liability and homeowners and auto, and I'll just get covered my umbrella. If you do that, essentially, you now have $100,000 deductible because until you hit what they assume you had covered on the underlying policy, until you hit that, this policy is not going to cover it. What's not covered, again, intentional types of things. Although intentional can be, there's some things where you do something intentionally, but you didn't intentionally mean to cause harm. So that can work. But our assault and battery, where you're trying to save someone's life, or self-defense, there's things like that are intentional, but they can still be covered. You can't insure your own property with this, business pursuits, professional liability, directors and officers, obligations and workers' comp, those things aren't covered. Now, the directors and officers I throw out there, I don't want to discourage you from volunteering, but there used to be in the United States that volunteers were somewhat protected from liability lawsuits, because it's good. You're a volunteer, you're on some board for a charity or at your church, and you're making decisions, and you make a decision that ends up causing harm. You say, hey, I was a volunteer and we want volunteers. Well, that's changing. People are getting sued now for being on the board of their homeowner association or whatever, even if it's not paid, because you are making decisions and you can be negligent in those decisions. My neighbor is the president of my condo board, And I get her a gift card every year because what she does for our condo is just amazing. She should be paid a $10,000 salary and even more. She does so much. I've been tempted to get on the board and help her out because it's just we ask way too much out of her, and she has people complaining to her all the time for stuff she has no responsibility for, but she takes care of us. She's making a lot of decisions. Yeah, it's just your homeowners and your umbrella are not going to cover those type of activities. So it's just something to think about. Not saying you shouldn't volunteer, but do realize the world may be changing, that you could now be getting exposure. All right, so I don't know if I have questions up to that point, but let me show you where we're going to go from here, because there's some really important stuff we want to do by next class. So out on our Blackboard, under contents, under miscellaneous materials, there's 2 articles I want you to read. The first one is called Mold Article Highlighted. The second mold article is really quick. If you don't read it, no big deal. I'm going to cover it in class. But I want you to read this first one. And then what I'll do, hopefully I remember next class, I always forget, but what I'll do next class is I'll let you out 15 minutes early, assuming you've watched this video. All right, I want you to watch this video. I'll send you the link. It's a Forensic Files. I don't know if you ever watched Forensic Files. Notice the name of this one. It's called Breaking the Mold. So no one was murdered. It's not a crime. It's all about an insurance company not covering mold and what happened. And the reason I want you to watch this is the article I'm giving you, which is this article, gives a somewhat of an insurance industry perspective. And you're going to notice the way it's worded. And I'm going to go through this whole article, so you don't need to take note. You just read it, get the sense of it, and then we'll talk about it in class. But I want you to read it before you watch the video, because I think the tone is very different. And then when you watch the video, I think you're going to get a very different sense of this mold issue. And this video is about, I think it's the Ballard family. I forget exactly the name, but they're mentioned in the article. If I can find it here. It's pretty quick in the article. Yeah, it's in here. Here it is. Dripping Springs, $32 million lawsuit, the Ballards. That's what the forensic file case is about. I was kind of shocked when I saw it. It's a big case. I met a couple that moved from Dripping Springs to Helotes, and I was riding by my bike, and this was many years after this case. And I go, "Oh, you're from Dripping Springs. Do you know about the Ballard case?" And they knew all about it. It was very famous in Dripping Springs, made the news. So I think you're going to read this and say, "Wow, this elite kind of petty couple, boy, they complain about this mold. They should have just cleaned it up themselves." Then watch Forensic Files. You may have a different perspective. I'm not going to say who's right and who's wrong, but you may have a different perspective. So I don't want you to be too skewed positive for the industry. I want you to see the other side. It's a 22-minute video, so I'll let you out 15, 20 minutes early next class, but you need to watch the video before next class. Any questions on that? I want you to read the article and then watch this video before next class, and then we'll get into this mold issue.
Can you show where the video is, sir? I apologize.
I'm going to put it in my weekly email.
Okay.
Y'all can see it up there, right? YouTube.com. Watch. If you want to take a picture of that or snap it, you can get it now. It's season 7, episode 37, Breaking the Mold, but I'll give you the link in the email.
Okay. Thank you, sir.
I think you'll find it an interesting. I love Forensic Files. They do a really great job of covering these stories, and they do a great job on this one. I think they cover it fairly thoroughly, although it's very skewed toward the Ballards. So you get an article that's skewed toward the industry. You've got this. And then I'll also tell you what the insurance commissioner of Texas said about this. He visited our class, but I don't invite him back anymore because it's just too long of a drive. But I'll give you his perspective as well. So this is a great case. It's old, but I can't find other cases that are as big as this that teach the lessons out of this. So it's a great example of especially for the actuaries and what this industry has to deal with and the issues that come up. It's just a perfect case. So the fact that it's several years old is really not an issue. All right, I'll let y'all out a little early. I'm checking roll from the Zoom. So if your name on Zoom doesn't look like your name in the class, you know, you might let me know that you are here, because I think most of you, I can tell who you are from your name. So, all right, thanks everybody. We're gonna have the Investment Society next, if any of y'all want to stay around for that. But all right, thanks.